Good afternoon, friends. In the lecture series on personal financial planning, we are discussing on retirement planning. In this lecture on retirement planning, I'll be talking about different saving options that are available for an investor for its retirement planning. And my focus has been on the different tax saving plans, that there are different saving options through which you can not only make your retirement for your retirement planning but also save tax. So from this point of view, I have taken different saving options and have tried to compare that how these saving options, what return they have provided during the last 5 years, and to what extent they are safe, means there are different parameters on the basis of which they have been compared. I'll be talking of that. So firstly, I am presenting you a table in which these different saving or investment options have been given, and then I'll be talking about the returns and the lock-in that are available. So this table has been drawn from an Economic Times survey, which is a leading financial paper of this country. The Economic Times Bureau has made a survey, and on the basis of that survey, their findings are, they have given their findings. On the basis of that, the table has been drawn. Means, at present in the year 2023, in the beginning of the year 2023, what are the returns which these different saving options have provided to the investors, and what is the lock-in period in these different saving options? See, while analyzing these different options, there are different parameters which we have taken. For that matter, if you take any saving options, you analyze that saving option on different parameters, and on the basis of that, an investor decides that in which saving option the investor should invest. Basically, since we are talking of retirement planning, so all these saving options will help the investor to make their future to make investment in a manner so that in future they will have good corpus of funds, and which is tax friendly, which is able to save tax. So in this way, first I will be talking of that these are the different parameters on the basis of which these different saving options, which I'll be talking of later on, have been assessed, and all these parameters have been given equal weights. What it means is that on the basis of, I suppose these are the 8 different parameters on the basis of which the different saving options have been analyzed, and then the ranking has been prepared. So these parameters are the returns, that is, whenever an investor invests in any investment option, the very first thing that comes in your mind is, what return you will be getting. When you go for take a very simple example, when you go for a bank for making the fixed deposit, the first thing which you ask is that what is the rate of interest that is going on a 1-year FD, 3-year fixed deposit, 5-year fixed deposit. Depending on a time horizon, you decide that of what period that you will make the FD, fixed deposit. It means that when you invest in any investment option, you see what is the return that will be provided, that you were expected to get in a bank fixed deposit, the return is fixed. But when you invest in the equity market, you know the return is volatile, is fluctuating, the return is not fixed. So there is a higher risk profile in that return. But at least you see that what expected return you are expecting by making an investment in the equity. What it means is that any investment option that you choose, that you analyze, you analyze on the basis of what return this investment will provide to you. The other very important parameter is safety of funds. The investment that you are making, to what extent it is safe. That is, like say again, I am taking the example of, now let me take the example of National Savings Certificates, NSC. You deposit the money in the post office in the National Savings Certificate, which provides you a guaranteed return of 7%, right? For a period of time, lock-in period is there, but there is a sovereign guarantee in it. The Government of India guarantees that after this period of time, you will be getting this much principal amount, and this much your interest amount. Means it provides almost highest degree of safety in the national savings certificate, or for that matter I can say even the bank fixed deposit or the government bonds or the treasury bonds, the bonds that are being provided by the government. So you analyze any investment on the basis of safety of your investment that you are making, that to what extent that financial instrument where you are investing your money is safe. So the return is one criteria, the other criteria is safety of fund. The other criteria is flexibility. When you invest in any financial instrument, you see to what extent it is flexible. Flexibility can be on various parameters. It can be on the parameter of whether you can withdraw the money, or the parameter can be, can you switch from, say, if you are investing in a equity linked saving scheme, so can you switch from one instrument to other instrument, from one equity linked saving scheme provider to other equity linked saving provider. When you are buying ULIPs, unit linked insurance plans, that whether during the time period, if you are not satisfied with the one insurance company which is not giving you the good return, because as you know in India these days not only the government LIC and the government sectors insurance companies are there, but there are whole host of the private sector insurance companies are there providing, and they give different returns on the ULIPs. I will be talking of all these in detail. The point is, you see that what is the flexibility that is available to you. So other parameter is the flexibility, return, safety of funds, and the flexibility of the investors, flexibility of investment, flexibility in terms of withdrawing the money, like on these parameters. The other is liquidity. Means when you need money, can you withdraw the money? What is the time period for which your money will be locked in? Like for example, when you invest in the PPF, Public Provident Fund, PPF, Public Provident Fund, at that point of time when you are investing the money, your money is locked for 15 years. The time duration is 15 years. That is, you can withdraw the money after 15 years only. If you need money earlier than that, you may withdraw a part of it in form of loan only. Means there is a lesser degree of liquidity as compared to the investment in, say, equity linked saving scheme where the lock-in period is 3 years. So you compare on the basis of liquidity, that what is the easiness with which you can withdraw the money, and not only you can withdraw the money, but what is the degree of fluctuations of your investment, right? So you analyze on the basis of liquidity. Then cost. Each fund house, each investment that is being made, the managers of the funds, say if you are investing in the national pension scheme, under the national pension scheme, the fund manager to whom you give the money, say UTI, Unit Trust of India, is one of the fund manager for NPS, National Pension Scheme. It has its own administrative cost, it has its advertisement cost, there are various type of cost involved. So what is the cost of managing the funds that you analyze? How much cost? Because ultimately the cost will be covered from you, from the investors. When I'm saying you, means all the investors. Suppose a particular fund, say for example a mutual fund, has a corpus of 20,000 crore rupees. So all administrative cost will be divided among the unit holders only. Ultimately the cost will be borne by the investors, right? So what is the cost involved in that investment? Then transparency is another parameter on the basis of which we analyze any investment. Transparency in the sense that the fund manager who is investing the money, that where he is investing or where your money is being utilized, what is the return you are getting, whether you can get on a day-to-day basis that what is the value of your fund. Today the investment you are making, after 5 years, after 10 years, you can always check that where the money has been invested, what is the return you are getting. And on a day-to-day basis, you can know the NAV on these things. So there will be a transparency, means whatever the fund managers, whatever the investors of the funds do, you know that what is happening of your investment. Then comes another parameter, is ease of investment. means ease with which you can make the investment. That is another parameter. And lastly, but not the least, is a very important taxability of income. The income which you derive out of your investment, whether it is taxable, if it is taxable, that to what is the rate of tax, whether it will be covered in the short-term capital gain, long-term capital gain, or the whole income will be taxed or partly will be taxed. Not only the income, but even the investments that you are making, whether it is deductible, whether it is eligible for deduction under Section 80C, or for that matter other tax provisions of this country. So these are the different parameters. I have just said in a very nutshell form that these are the, I suppose, 8-9 parameters on the basis of which we are analyzing. And what has been done is, all these different parameters have been assigned equal weightage. And then on the basis of that, that is the return of the funds, safety, flexibility, liquidity, costs, transparency, ease of investment, and taxability of income. On the basis of these parameters, they have been given equal weights. That is, all these parameters were being given equal weights, and weighted index, weighted parameters, on the basis of these parameters, a weight was being assigned to all these equal weights was being assigned, and on the basis of that, it was being calculated that what is the priority, or what is number one, now it is number two, what is number three, on the basis of these parameters. So on the basis of that, this conclusion was being drawn. That is NPS. I am talking of the year 2023. Friends, at different point of time, the different schemes can be more beneficial for the investors. But given the present scenario, present rate of interest in the country, given the level of equity market, the level of debt market, right, these rankings have been made. So the NPS and what is the return of each of the investment, I'll come to that first and then I'll come to other things. National Pension Scheme, that is investment in the National Pension Scheme. And friends, let me make it very clear, you should be very clear, this comparison had been made on the basis of these different parameters which I have just talked about, plus keeping in mind the tax, that is, since this is the month of the January and in the month of the financial year is about to end. So most of us have to clear we have to assess our tax liability, and at that point of time, we make the decision that where to invest for our future retirement planning, where to invest for our long-term investments, so that there are twin main objective, so that it can give you good return, plus it can give you some tax savings also, right? So on the basis of that, the different rankings have been made, but ranking is not with the focus that only on the basis of this ranking will be discussing that these are the options, and these options have given this much return over a period of time, so that any person who want to make retirement planning can take a wise decision, right? This is the objective. So the first thing is NPS, National Pension Scheme. If you see the average return, because in the National Pension Scheme also, there are different fund houses which are managing these different NPS, right? They are in the private sector, also in the government sector. So these fund houses which have been assigned the responsibility of managing these national pension schemes, their return also varies, right? So it comes to be, on an average, if you analyze the return of the last 5 years, it is between 8% to 11%. When I am saying between 8, you may say that there is a big gap between the 8% and the 11%. So 3% variation is a quite big variation, is a large variation. But since there are different fund houses, so different fund houses, depending on their own strategies, right, have performed accordingly. So average return of the past 5 years is 8 to 11%. And what is the lock-in period? Suppose if you are, say, 21 years of age, up till what time you have to block your fund? See, these national pension schemes means popularly known as new pension schemes. The investment that you make, that is withdrawal at the time of retirement. So your investment remains locked in till the time of retirement. The other is unit linked insurance plans. Unit linked insurance plans, it is a mix of both equity and insurance. That is, I would say, in the unit linked insurance plans, you have twin benefits. Benefits of insurance plus benefits of investment in the equity and the debt market. There are many insurance companies in India like HDFC Life, ICICI Pru, Life Insurance Corporation, which is the largest holding of ULIPs, right? And even Edelweiss, Tokyo. There are many companies which offer ULIPs plan. In the unit linked insurance plans, as I said earlier, it's a mixture of insurance as well as the investment in the equity and the debt market. You get the benefit of that. Any investor who invests in the ULIPs gets the benefit of both the insurance as well as the investment of equity and the debt market. See, if you invest only in the insurance, you get an insurance plan. Insurance plan is basically the protection of your life, in the sense that in case anything happens to your life, your nominees will get money. The funds by the insurance company, the premium which they collect, they normally invest in the government securities, treasury bills, money market instruments, right? Means which are considered to be very safe, but those investments gives a lower rate of interest. What it means is, if you buy pure insurance plan, in that case, it is the life that is insured, but you will not able to get the benefit of the investment in the equity and the debt market. Those investors who want higher return as compared to the pure insurance, they want that their life part is secured, and plus they get the benefit of investment in those equity and the debt market. So they can go for ULIP plans, unit linked insurance plans. But friends, let me tell you here, when you buy insurance plan, pure insurance plans, there is no fluctuation that takes place. There is no, means at the insurance company at the time of making the plan, or any investor or any person who is buying an insurance policy, at that time itself, the person knows that this is the premium which the person has to pay for this much period of time, for the period for which the person is buying insurance. Suppose you are buying insurance for 20 years, right? So you know that up till 20 years, that is for 20 years, that you will have to pay this much premium, exact amount of premium you have to pay. And after that, you will get a fixed sum of money plus the bonus accrued thereon, depending on the insurance schemes. If anything happens between this period of 20 years, then the insurance company will pay the full amount of the insurance as I showed. Under the unit insurance plan, the value of the investments keeps on fluctuating. So that's why the investor is able to earn a higher return as compared to the pure insurance plans. And the benefit is that if anything happens during the tenure, suppose you buy a ULIP plan for 5 years, and during that 5 years, in between that 5 year, something happens to the person who has invested the money. So his or her nominee will get a fixed sum of money that has been assured, means like the insurance company, like in the case of pure insurance plans, a sum of money is being insured, that if anything, means if the investor dies, in that case the nominee will get the money. In the same manner, in the ULIP plans also, if anything happens to the life of the investor, of the person who has invested the money, right, during that tenure of 5 years, if anything happened, a fixed sum of money is being given to the nominee of the investor without paying further premium amount. So you can buy the ULIP plans also. So if we analyze the return of the last 5 years in the ULIP plans, on an average, different companies have provided different returns. On an average, it gives returns of 8 to 9%. When I'm saying on an average means, when we analyze the different companies which are offering ULIP plans, just as I said earlier, like Life Insurance Corporation of India, the HDFC Life or ICICI Pru, Edelweiss Tokyo, these are the various insurance companies which have ULIP plans. There are many more, so I have taken only important names. So these insurance companies have given 8 to 9% interest in the 8 to 9% return, not interest, is not fixed. So 8 to 9% return in the last 5 years. And the lock-in period of the ULIPs is 5 years. And friends, all these plans which I am discussing, they have a tax benefit also. That is, all these plans have are the investment that you make up to 1.5 lakh rupees, that is deductible under Section 80C. Means when I am saying deductible from salary or deductible from income under Section 80C means, say my gross salary is 50 lakh rupees. From this 50 lakh rupees, if I made investment up to the extent of 1.5 lakh rupees in any financial year in a ULIP plan, so this 1.5 lakh rupees of investment will be deducted from my total income. So I'll be taxed not on 50 lakh rupees but 50 lakh minus 1.5 lakh, that is 48.5 lakh. So investment that you made in the ULIPs is locked in for 5 years. The third investment option that is available to an investor, or from the tax, all these investment options we are basically discussing that from the tax point of view. So equity linked saving schemes means third in the ranking as per the 2023 data, means we analyzed in the year 2023. The third ranking comes of equity linked saving schemes. What is this equity linked saving schemes? See, in order to promote equity cult in this country, because in a country like India, where we are almost 135 crore people, a very small percentage of population do invest in the equities. So, world over, especially in the developed countries, a large portion of the saving is being invested in equity and the debt schemes by the investors. But in a country like India or developing countries, especially I am talking in terms of India, not a large portion of the saving goes in the equity. So, in order to promote equity linked saving or equity cult in this country, so that more and more retail investors, small amount, more and more small investors, small savers or small investors can also invest or should be promoted to invest in the equity, the Government of India has given relief in the income tax under Section 80C, that if you invest in an equity linked saving scheme where the lock-in for 3 years, again many mutual fund houses, right? I am not naming mutual fund houses, they provide these equity linked saving schemes, which are especially people do invest in the equity linked saving schemes, keeping in mind the tax concessions. But suppose I invest in any mutual fund in, say, equity plan. After 1 month, if I need the money, I can withdraw the money depending on the net asset value at that point of time. Obviously, there will be some exit load. Exit load means when you invest in mutual fund, normally at the time of investment, mutual fund houses reveals in their contract or say agreement that if the money is being withdrawn before 1 year, this much will be the exit load. Exit load means on the base of that day NAV, a fixed percentage will be deducted, and normally it varies 0.5 to 1%, right? But under the ELSS, the lock-in period is of 3 years. That is, once you invest in this in any equity linked saving scheme, the minimum lock-in period means you cannot withdraw before 3 years is 3 years. But again, that is deductible. Your investment up to 1.5 lakh rupees is deductible under Section 80C. And the return that has been provided in the equity living saving schemes is on an average is 9.65% during the last 5 years. So what you have observed is that in the national pension scheme, return is 8 to 11%, depending on in which plan you have invested. In unit-linked insurance plans, the return is 8 to 9%, but the lock-in is 5 years. But the NPS, the lock-in is till the retirement, till the age of 60, right? And the equity-linked saving schemes, the return is almost 9.65 for the last 5 years. It is the average return of the last 5 years, and the lock-in period is 3 years. The other is senior citizen saving schemes. That under the senior citizen saving schemes, which this scheme is available only for the people who are of 60 years and above, right? So under the 60, at present in the January, the Government of India, January 2023, the Government of India has revised the rate of interest to 8%, right? Lock-in period of this is 5 years. So friends, in this lecture, I have given you 4 different investment options, and we have analyzed that what return these investment options have given in the past 5 years. You may say, when I am talking of the senior citizen scheme, I have given only the latest, because you can't say return average. It is the rate of interest that is being provided at a particular point of time. Means if today I deposit my money in a senior citizen saving scheme, throughout the life of 5 years, I will be provided with 8% rate of interest. So the point at which you deposit the money, at that point of time, whatever the rate of interest prevails, that rate of interest remains throughout the tenure of 5 years. So rest of the investment options I will be talking in my next lecture. Thank you.